Hello guys, this is Matt Z from Optimus Futures, www.optimusfutures.com. Today I'm going to talk about market edge versus your edge. And it's very important to distinguish between the two. I'm quite surprised that there isn't enough podcasts or blogs or anything written out there that actually explains the difference between the two. And I think they are both equally important, but I don't see out there in the industry people actually, comparing them to one another. There is a lot of talk about the word edge and your edge and market edge, but I think people don't distinguish between the two. So I'm going to try and explain the difference so you guys understand it. So when we talk about market edge, it's basically where you find a pattern of trading. So this pattern of trading is one that you try to capitalize on, and it could be in technical analysis, it could be moving averages, RSI, MACDs, could be order flow where you have interaction between buyers and sellers, it could be support resistance, it could be Fibonacci, it could be anything that allows you to capitalize on seeing the pattern. And what you want to do is basically trade that pattern. So every time you see it, you trade the pattern, avoiding any emotional outbursts there of, fear, greed, FOMO. You just wait for the pattern to occur. You capitalize and you try to capitalize on it. So the goal is to trade that pattern, right? Along with observing the pattern, you also want to develop a risk management around the pattern. So you watch the pattern, you see it occurring, you try to execute the pattern, and then basically you develop a risk management around it. What is the risk management? Risk management is there to say, okay, the pattern has occurred, but the market did not follow through. So where am I wrong on this? Basically, you're looking for a point to exit where your first assumption about the pattern is no longer valid. It could be a stop loss that you put in terms of a financial one that matches your risk tolerance, which is not really the preferred way to do it because your risk tolerance has nothing to do with market fluctuations and trends. However, you can always resort to that. The other more preferred one is basically based on support, resistance, or a condition that you say, the market has moved on beyond this pattern and it's not recognizing it anymore. And hopefully, you're able to minimize your losses and cut them short. And again, if you're getting stopped out, then you're watching for this pattern to repeat again. If you are able to capitalize on it, great. And you also have to develop a plan for that. Where do you actually take the profit for this pattern? Now, let me just explain something here, which is very important. If you listen to previous podcasts, I always said, the word market edge is being, it's a little bit overused because a lot of traders, do not understand the concept of this. So market edge is very important, no question. But I think the term is blown out of proportions because it's really your trading skills that would make a huge difference in the performance of your account. So it's one thing to recognize the market edge and recognize that pattern, but it's a totally different thing to capitalize on it and to develop a risk management around it. This is where your trading skills come very handy. So if you find a market edge, but you don't have the trading skills to capitalize on it, if you don't have the trading skills, in the marketplace, a market edge in itself will not make you money. Remember, it always boils down to market edge plus trading skills, okay? And that's what hopefully will make you profitable. Since I'm talking about stop losses, just be careful with stop losses. They don't always get stopped exactly at the point that you want, and there are market conditions that it might not even be executed, so always watch your trades. Okay, so now we covered what is a market edge. Now let's talk about your edge. All right. So let's say you developed a certain market pattern, you trade it now, and you've gathered enough data at this point to start analyzing your trades, right? So you gathered the data, now you're analyzing the data, and now you have to look at your best performance. And I'm going to use here hypothetical numbers just to make them round and easy. But let's say you gathered 100 trades that you have done, right? Or 1,000 trades. It's entirely up to you. Now, your method could be profitable or not profitable, right? But at this point, it's really irrelevant. What you want to do is really look at the data and look at your best performance, right? So let's say you have 100 trades and in 30 of those trades, you've made money. So you lost 70% of the time. You've made money 30% of the time. Now what you want to do is look at the 30% and the 30 trades, which is the 30% out of 100, and say, okay, what have I done right here? What made me act right here? And this type of analysis will give you some sort of a dive into your method, and it could potentially even give you a dive into your market edge. So you will start noticing certain patterns. For example, you will notice, and again, this is whole, I'm making it all up, but just to make it easy, but those things could happen in real life. You just have to find where your edge is. So let's say you find that your best trades occurred between 1 o'clock and 3 o'clock. You could find that if you trade multiple markets, that it's actually the treasury notes that made you money and not your E-mini S&P, although you'll love E-mini S&P, right? You can maybe see that early in the morning, this is where you had the best opportunities to take the most amount of money. And that sort of thing, looking at your best performance and seeing what you're doing right over there, now you can compare it to the other 70% and say, okay, what am I doing right in this 30%? What am I doing wrong in the 70%? And you either try to compare between the two and try to improve the 70% or just completely neglect it. Say, you know what? I'm just going to focus on the 30% that I'm doing right. That's the only thing I want to do. And that in itself helps you optimize your performance. Because here is a fact, okay? The amateur traders and the beginner traders, they think they'll have a method for all seasons, right? So they want to have one method. This is why they refer to the word the best, as I always say. They want to have the best moving average. They want to have the best hours to trade. They want to have the best market, the best setup. They always use the word best. But really, in reality, you know, what I consider to be best is really in your analysis, in your data. And so if there were two traders and both of them had the same market edge, let's assume that there are two traders who are trading support and resistance levels, right? With some sort of a moving average. And let's say they're trying to be a little bit exotic and they're having some sort of an order flow attached to it. So they have those four factors, and they say, within those four factors, this is what I'm going to go long and short on my future contract or any other asset that you may trade. Here at Optimus Futures, that's what we do, futures. So essentially, they might have the same pattern, but they both could be trading it completely different. Now, let's assume that both of them are profitable traders, okay? Just for the sake of the example. I bet that both do not have the same edge when they analyze their data. So they might execute around the same time, but the way they manage the trade could be different, or the way they interpret the market edge is different, so they might be executing also at different times. I should really, emphasize that. I didn't mean to say that if two people have the same market edge, they actually execute at the same time. No, I don't know such things. What I'm trying to say is that both of them will have the same criteria, but they might exercise them in totally different times, the way they interpret it. And they might find also that their edge is completely different. one guy could, makes money, on longer term, like for example, being 3 to 4 hours in the market, and another person could be making money just being 15 minutes in the market, and it's fine, but they both found their edge. Now, going back to what I told you about that people look for best this, best that, the reason that you want to avoid that type of thinking is because you will change as a trader. Professional traders, the way they traded in 2008, it's not how they traded in 2012. The way they traded in 2012 is not the way they'll trade in 2015. And today we're at 2021. It's not the way they traded in 2018. So they always improve their edge. And the reason that they improve their edge, because they are trying to do certain tweaks to the things that they're doing right and experiment with them to optimize their performance. They're doing it because their performance may suffer at some point. So they have to, again, to go back to what they're doing right. They're trying to tweak a method just by small changes, and that might optimize their performance. So again, let's say, somebody has a sample of 100 trades that they have done. Now they're going to 30, right? Now they're exercising the 30, exactly that what the data that they found in the 30, the way they're analyzing it, and now they're trading only the 30%, right? Only the method that's it. So now they gathered another 100 trades, and within those 100 trades, again, there will be winners and losers, and now they have to go back to them again. So this is just finding your edge, and starting to analyze your edge will give you the ability to really make small incremental changes to your edge without throwing away the method altogether. Because this is what majority of people do. They do not understand the difference between market edge and their edge. They always say, just give me the edge, give me that pattern. And this is not what's going to make them successful. It's maybe hard for them to understand, but your reaction after the trade, where you take your profit, where you try to cut your losses short, where you get out of the trades, the way you handle your consecutive losses, that's what really makes professional traders, their ability to handle those things, not just every time they fail to throw it out. So data gathering is really important. So you start with the market edge, you find the pattern, you move on to finding your edge within that pattern. The complement of the two hopefully will help you gather to the next stage of being a professional trader. I hope this was helpful to you. I always welcome all your comments. You can go to community.optimusfutures.com where we have some market discussions. If you are looking for a broker, I always welcome your business. I would love to earn your business. You can go to www.optimusfutures.com, and you can also call us toll free. It's in North America. It's 1-800-771-6748. If you are using a local number, it's 561-367-8686. I know there's a lot of competition out there. I know there's a lot of good brokers. If you happen to be in a place where you don't get the service, you don't get the education, and we can hopefully further everything for you, I would love to do it. So again, would love to earn your business, as I always say. I wish you well. I wish you a great week and a great weekend, and I'll see you on the next podcast. Thank you again for listening.